Welcome to TaxLink's latest webinar. Today we have part 2 of our webinar on issues in citizenship-based taxation in the United States and beyond. We received so many questions for the first session that we immediately decided to host a second one. Let me get some admin issues out of the way, and there's already talk of hosting a third one, so hopefully we'll be able to set that up sometime in late July or August. I'll get some admin issues out of the way before getting started. The webinar is being recorded. We will have a video and audio recording available probably later this week. And also, we will have a full transcript available to all of you. If you missed the first part, there is a transcript available already on TaxLinked. There's also the video recording, so you can check that out at your own leisure. We are offering CPD credits for this event. Just make sure that if you want the CPD credit, you're paying attention. The system actually tracks who is paying attention, who's not paying attention. So, you know, you have to be kind of like listening in on to be able to get that CPD credit. Also, for those of you who are listening, I'm not sure you're aware, but TaxLink is hosting a conference in Barcelona, October 13th to the 16th. It has all to do with international tax and law. We have all sorts of different topics that we'll be covering. One of them is we'll be answering the question: is the U.S. the greatest or the biggest tax haven in the world? I know John Richardson is going to be one of our panelists at that session. So, you know, if you want to join us, get in touch. We have early bird tickets out available right now. So, you know, feel free to get in touch with me or with Masha, and we'll, you know, get that going, get that process going for you to get a ticket, etc. So without further ado, I'm handing on the reins to John, who will be moderating and leading the discussion just like last time. And I'll jump on board again an hour from now when it's time for us to wrap up. Okay, thanks. Have a great webinar. Bye.
Okay, well, thanks very much, Mateo. Actually, before we jump into this, let me put in a plug for the conference in Barcelona for anybody listening. I was at the one last year in Cyprus, and it was without a doubt one of the best, most educational, and certainly most fun experiences that I've had at one of these things, I think, ever. So I would encourage, I think Barcelona's a slightly better location for people than Cyprus. And if anybody's on the fence or anything, I would opt to get yourself over to Barcelona. In any case, so my name is John Richardson. I'm a Toronto, Canada-based lawyer who works with people afflicted with U.S. person problems throughout the world. I had the distinct privilege of moderating the first of these. Karen is back with us. Larry, I think, was supposed to be at the first one, wasn't. So if I could begin by perhaps getting Larry to introduce himself to you.
Sure, it'd be my pleasure. So my name is Larry Stern. I am a U.S. CPA with over 20 years of international experience. I specialize in U.S. tax issues for citizens abroad, which is primarily our discussion topic today, as well as foreign investors, corporations that want to invest in, open up businesses in the U.S., and so forth. I'm a partner at Abulafia Avital Shrensky in Tel Aviv, Israel. And I'm very honored to be joining this webinar and being a panelist.
Well, thanks for that, Larry. And you mentioned that you work with citizens abroad. What is your prognosis with respect to continued U.S. citizenship abroad, given all of these problems?
It's a challenge. It's a huge challenge. There have been obviously recently some changes for the better. I don't know if I believe we'll probably touch upon it a little bit with the guilty high tax exception that's been announced or at least proposed recently. So there's a little bit more visibility to the issues of U.S. citizens abroad. But I'm not totally hopeful that there's going to be a full-blown solution or major change to the tax code anytime in the immediate future.
Would you consider the holding bill to be a major change?
I think it could. I think it could. The current bill at least may provide a lot of relief both from a compliance perspective as well as a tax perspective, for those individuals that are in what are called high tax countries, where there's a tax rate in excess of 18.9% of corporate tax, so under 962, which allows for a treatment of an individual as a corporation, and they're in a high tax country, similar to subpart F, where you have a high tax exception. You may be entitled to a high tax exception as well without the need to comply with the major aspects of guilty. So that actually provides relief, or can provide relief, to individuals that are coming from countries that have corporate tax rates that are located in countries that have tax rates in excess of 18.9%. So I think there is definitely some benefit to this proposed legislation. It's not the solution that any of us probably would want. It would make more sense to move over to residency-based taxation, like 99% of the rest of the world. But
99.9% of the rest of the
exactly. I'll take what we can get in the meantime to help our clients.
Sure. Keeping a focus on that for 1 second and bringing Karen in, although this is not on our agenda specifically today, since this is very timely. You've opened the door to the high tax guilty exclusion. I thought I just understood you to say that applies in conjunction with the 962 election. Is that what you said?
Yes.
I think my reading of that is that that what it does, see, the 962 election would apply if you had guilty income, I think, wouldn't it? We need a 962 election, Karen, to take advantage of this new proposed high tax kickout, so to speak.
I don't think you do. I think it just says it's not guilty. It's not considered guilty income if you're paying more than 18.9%. And if it's not guilty income, then I don't see the need to do the 962 as well.
Yeah, again, this is also new. That is my impression of it as well. I mean, if we look back to, this has been very, very interesting to me, because I really have got to take my hat off to Treasury this year for creativity on how to mitigate the guilty problem for individual shareholders of CFCs, because in March, we have what I think is the unbelievably creative and interesting interpretation of 962 in conjunction with subpart F, which they say compels the conclusion that individuals get the 50% discount on the guilty, notwithstanding that it doesn't say that in the Internal Revenue Code. So in other words, in March, they say, well, if this is guilty, we're going to give you a 50% discount. And then in June, they're saying, and you know what? If your tax rate in your country where you're living is over 18.9%, then it's not going to be guilty at all, making it even easier.
But it's talking about the corporate.
How much discretion they've taken in both of those things, and I'd like to see them take that same level of discretion, and initiative in a lot of other areas where there is, maybe some arguable discretion on the part of the IRS to
including the transition tax, I would think, right? I mean, that's sort of the
transition tax, but even things like, they manufactured a higher threshold for the 8938 if you're living outside the U.S. They could manufacture a same country exception, I think, just as easily.
You think that's true, Larry, given your reading of the statute? I remember we're bound by the statute. This is the problem, and the opportunity.
Yeah,
Sure.
but the 18.9% is not in the statute either.
It is in the statute, because it says 9%.
It's based on the subpart F rules.
Yeah,
it's based on the subpart F. It's based on the subpart F rules, where you're talking about 90% of the maximum U.S. rate. But
that's not how anybody read the 851A provision about high tax.
True.
Absolutely.
So 851A doesn't really say that you can use that high tax exception.
You know, after, Karen and I had some back and forth email on this, after the initial, what just happened, my feeling is that that was really a direct response to that Arnold Porter submission to Treasury, which actually came from the government of Israel. But in any case, maybe we better move back to the agenda here a little bit. Actually, let me ask Larry one other question.
Sure.
So I was actually asking you what you thought of the holding legislation generally, not so much the 951 high tax kick out. The proposal from, or, if you're up on it, if you're not, I mean.
I'm not fully in depth on it. I've actually been on vacation for the last 10 days.
Okay,
So,
that's fine. Let's not guess that. That's fine. Okay,
no, I
great.
appreciate it.
I appreciate the introduction from you, Larry. That's great.
My pleasure.
Okay, now, so I got a list of questions here that, you could look at them in one sense as overflow from the last one. But, this whole thing got started with the title citizenship taxation. Yet, there's all these questions having to do with FATCA.
Yeah.
And I find this fascinating because I'm not sure that talking about FATCA is necessarily responsive to the citizenship taxation issue at all. Karen, what are your thoughts on that?
So, my thoughts basically that there was a very large proportion of Americans overseas who had no clue about their U.S. tax obligations until FATCA came along. So the reason everybody's all worried about FATCA is because that was the first thing they heard about. All of a sudden, their banks ask you their social security number.
Yeah. If I were to ask you a real simple question, okay, which is sort of like, what's FATCA got to do with citizenship taxation anyway? How would you answer that in its most simple terms?
Yeah, and I'd basically say it's the enforcement arm.
Larry, your thoughts on that?
Yeah, look, historically, the whole idea of filing an FBAR started in the 1970s. The penalty for non-filing was $200. It wasn't anything of any major consequence to anyone. Then 9/11 happened. Then the increase in penalties in 2004 from $200 to $10,000, hoping that people would become more compliant. That never happened. And then in 2009, we had the entire FATCA legislation that basically imposed the American will on non-US banks. Basically said, you need to give us information, and if you don't, we're going to withhold taxes, okay, 30%. And then came all the intergovernmental agreements for exchange of information, and within those requirements, and we've seen it in Israel with a number of banks, obviously Switzerland as well, where the banks have gotten penalized. The whole obligation of these financial institutions to provide information to America at the risk of being penalized substantial sums of money, basically made these financial institutions become enforcers for the U.S. tax, for the IRS.
All right. So what they're enforcing now is this whole notion of CBT, citizenship-based taxation.
Correct.
Right? Now, let me just ask
what they're
you.
enforcing is reporting. Well, there's very few countries where they're actually requiring that they see actual tax returns. I mean, in Australia, so you give the bank your social security number, your information goes over to the IRS, but the IRS isn't doing anything with it. At least not yet.
Okay. Yeah. Well, we don't know, where this may go, but I think that realistically what's happening, at least the way I experience this vicariously through people, is that, so through FATCA, the IGAs, what have you, okay, essentially, the United States has downloaded to the banks what I would call a search, a hunt for anybody to the U.S. and its sole discretion can be a shifting definition, defines as a U.S. person. Agreed?
Mhm.
So you show up at the bank and the bank says, I sense U.S.ness. Are you or have you ever been an American citizen? So what happens then is the person goes out of their mind in panic, recognizing, of course, the most frightening thing in the world today is an accusation of American citizenship. And then what they'll do is they'll run to somebody like Larry who says, yes, it's true. Yes, I'm going to help you comply with your U.S. tax obligation. Gross oversimplification, but you would agree with that?
Generally speaking, yes, but you try to give the clients all their different options about how to comply. It can be from everything from giving up citizenship to filing tax returns. It's not just a matter of compliance. There are alternative options that they have available about how to comply. I mean, there are amnesty programs. There's non-amnesty programs that So there's no one set solution for each individual or potential client. You have to look at each person's individual circumstances and say, what is the right thing for this client, and it's not something that we can determine either, but it's something that we need to give the clients their full range of possibilities. You can't just say you have to comply. Yes, by law you have to comply, but you might have other alternatives as well.
But regardless of the alternatives, and I commend you for giving them and explaining, the options. Not everybody does, so congratulations on that. But what is going on is that they go to somebody, okay, who they consider knowledgeable, whether it's a CPA or your partner Leonard is an EA, I understand.
Mm-hmm.
And the bottom line is, oh my God, I'm a U.S. person. Some kind of response to this situation is required. Yes?
Yes.
Okay. So, Karen, would you agree that that is what we mean by sort of the enforcement of citizenship taxation? What it really is using the banks to hunt them down. Okay, the expectation being that they'll go to the compliance people, generate some kind of a response to the situation that certainly would not have happened pre-FATCA for the simple reason that nobody was hunting them down pre-FATCA. Would you agree
Right.
with it?
Absolutely.
Okay. All right. Now, I'm going to make a statement.
John, I'm sorry. Karen, are they asking for copies of tax returns at the bank?
Not in Australia. No,
Okay.
the people I've heard who've had that problem have been in Switzerland, and I think someone in the Netherlands was having that as well, but
That
not
happens here in Israel as well. Some of the banks are extremely aggressive.
paranoid.
Paranoid is a good word, and aggressive in making sure that they view compliance. And we've been pushing back, at least from our end. If nothing else, blacking out everything else that the individual has and providing them, let's say, Schedule B with the bank line entry showing the interest or whatever,
The acknowledgement of the FBAR.
or the FBAR with all the information blanked out except for their account, because really none of these banks
Absolutely.
information, rights. First of all, to be asking for the tax returns, in my opinion.
There's nothing in
They
the
have
IGA.
they have absolutely no right whatsoever. There's no IGA that even hints at that sort of thing.
I agree.
It, in my view, is an absolutely outrageous intrusion into the rights of these individuals. But in Israel, you would be on top of this, Larry. I think I've only read about this, fortunately. But in Israel, there are a number of banks who entered into non-prosecution agreements, right?
Correct.
Yeah,
Correct.
okay.
There are at least 3 or 4 that are either already have or are in discussion.
Okay,
and it's primarily all the major banks in Israel.
Okay, all right, so that's a problem. Okay, now, I was reading an article in a UK publication a while ago who made the following claim, and I'd be interested in each of you to respond to this. He said that really what FATCA is doing in these IGAs is actually creating U.S. taxpayers where they didn't exist before. What do you think about that, Karen? You know,
I
it's
think
like
that's
it's
true.
like yeah, it's like they're saying, geez, you know, our problem in the U.S. we just don't have enough taxpayers. Why don't we go get some more? Yes.
I mean, when you take someone who's been in Australia for 20 or 30 years, may have grown up in Australia, but been a US citizen either by birth or by descent, and the bank's telling him, oh, you're a US citizen, we need a social security number. And, you know, these are people who, number one, had they known they were US taxpayers all along, they would have arranged their affairs so that they would pay no US tax. The Australian tax rates are high enough. You know, they're higher than US tax rates. But if you don't know that you have to arrange your affairs that way, it can be really, really messy for these people trying to come into compliance.
It can destroy their retirements easily.
Absolutely.
Okay. Larry, FATCA creating U.S. taxpayers?
I'm not sure that FATCA creates U.S. taxpayers because, again, as Karen said, I think a lot of people who are now coming into compliance, I would say, you know, statistically, most of them don't owe U.S. tax. Israel also has extremely high individual tax rates.
Larry, most people in the United States don't owe U.S. tax either, right? And they're still considered to be U.S. taxpayers, right?
Yes, but I hear what you're saying, but it's still the idea that the idea that they're creating taxpayers assumes that they're paying tax, at least in my opinion. Putting aside transition tax and putting aside, you know, guilty for the moment, okay? Especially in countries.
Larry, are they creating people who now understand they have an obligation to file
Oh, yeah.
some kind of return?
Yeah. So to be compliant, yes. The need to be compliant, yes. I'm not sure what they're gaining out of it, though. You know, normally the goal would be to collect taxes. And if these people aren't going to owe taxes.
These people who had no idea they were US taxpayers. So they took advantage of Australia's superannuation, made extra contributions. And now the IRS says, oh, well, that's a foreign grantor trust. We want, you know, we want to tax all this money that's inside your super that you can't even touch until you're 65. You can't touch it. And, you know, so how am I supposed to pay the tax on that when it's all inside my account that I can't touch?
That's another example of what I call fake income, right?
Yeah.
Oh, I completely agree.
Or I sold a house, because that's tax-free here in Australia.
Sure.
If you sell your primary residence.
Look, with regards to
some of the places in Sydney, house prices have been, you know, going through the roof. You know, you sell a house, you get $1 million gain. That's normal.
Right. And here in Israel, the house sale, as an example, is actually tax-free. If it's your sole property, and and the gross proceeds are under about $1.25 million. So dollars. So it's
completely tax-free here if it's your primary residence.
So the idea of putting somebody into tax or causing somebody to pay tax on something like that, you know, it seems excessive. But again, you know, Australia and the US, you know, from a tax treaty perspective, right? They remind me, do they have a tax treaty or
yeah.
Okay.
Actually, the answer is no.
We have a treaty. The last
yes, but really no.
2001, and it didn't include superannuation, which had been on the books for 9 years at that point.
Exactly. So that's what I'm saying. A lot of the more recent treaties, you know, that have come into play actually address the local pension
yeah, we need that
treatment. And something like that could be helpful, at least to resolve some of the outstanding issues. I believe there are some practitioners that basically will say, listen, under the OEC's model treaty, you know, this is the position, and even if the treaty itself doesn't address it, they would take a more aggressive position under those circumstances. I'm not sure that that I necessarily agree with them under the, under that, from that perspective, but I have heard about some practitioners doing that.
In Australia, the more, it's not common, but there are a few who say, well, look, superannuation is a substitute for the age pension. We have a totalization agreement. It's Social Security. It's a privatized Social Security. And there are some practitioners who take that position, and I'm not aware that the IRS has pushed back.
Well, actually, quick diversion on that, but I don't want to get going too long on it. But the Eshel case, is it Eshel, S-H-E-L, the Eshel case, the DC Court of Appeals handed down a decision in 2016, and the IRS, I think, caved a week or so ago on the issue of some of these on the issue in France, whether the certain taxes were income tax or Social Security taxes.
Mm-hmm.
What was interesting, what I thought was incredibly interesting about the decision was that it made it very, very clear that this is not the IRS's decision at all. These treaties are agreements between sovereign countries, and these things need to be interpreted in accordance with the expectations of both parties.
Mm-hmm. Right.
Which, I mean, I agree, is a bit of work. But the point I'm making here is that it seems to me that the national anthem of the tax compliance industry seems to be, well, what's the IRS's view of that? Of how something should be treated under the treaty. And it's not irrelevant. But clearly that decision reinforces that it's not determinative either, right?
Mm-hmm. Yeah.
The IRS is not a legislative body. It's an interpretive body, and there's no reason why you can't, a tax practitioner can't have a different interpretation than the IRS. The question is, how far do you want to take it?
Right.
Or are we willing to take it? You need to find the right client that is willing to go that route. Look, from an Israeli perspective, Israeli social taxes, because we don't have a totalization with the U.S., in theory, should be creditable under under the 1116 rules as an income tax.
Well, are they not? Are they not?
The IRS has definitely pushed back at times. I've had clients where I've taken that position, and the IRS has disallowed it. But again, depending on the amount of tax that it's going to cause, the question is it cost effective to try to fight the IRS on the matter? So, unless you're finding the right client to take that further to the courts or things like that, I think it's pretty clear, in my opinion, a professional opinion, that Israeli social taxes, because there's no totalization agreement, is creditable as a foreign tax credit. It's just a matter of how far do you take it.
Well, they are taxes based on income, correct?
It is based on a percentage of income, yes.
Okay. Well, that seems to me to be a very, very good start. Okay. All right. Now, sort of trying to stay as much as we can on top of all these things run all over the place. The United States is the only country in the world where this is a problem, right? I mean, it's the only. Don't say Eritrea. Eritrea is a stupid excise tax, okay?
Yeah.
You would agree, both of you, the United States is the only country in the world with this?
Absolutely. Mm-hmm.
Why should other countries put up with this at all? I mean, now 3 weeks ago, I asked your partner the following question, Larry. I think I'll ask you this question. All right. Would you agree that things like the transition tax, the exit tax are not based on realization events?
Correct.
Okay. Would you then agree, okay, that since they're not based on realization events, that there is, at least normally under most circumstances without creativity, no Israeli tax to use to offset these things as tax credits?
Correct.
Would you then not agree that these kinds of taxes, which are basically fake income, are essentially siphoning Israeli capital out of the country to the United States?
Yes.
Why is that not stealing from another economy?
Oh, it is.
Okay, thank you for that. Thank you.
It is,
all right.
and the thing is, the U.S. can get away with it.
John, there's no other way to explain it. But I wouldn't necessarily look at it as, you know, yes, it's stealing in one sense, but I think it's, in my opinion, it's overreach. You know, the U.S. can have its laws.
It is that too, yes.
The U.S. can have its laws, and each country is entitled to its own, you know, tax code and everything else. But it really goes back to the basic question of our webinar today. Why, you know, from a fairness perspective, citizenship-based taxation, when it's inconsistent with the rest of the world, is truly a, you know, it's I don't even know how.
It's obscene. Yes.
It is obscene. It's obscene. It's insane, and it's, you know, it started.
Immoral?
I think so. I think so.
You are the first CPA who I've ever heard have a sense of morality. I thought the requirement to be a tax professional was that you had to be completely amoral.
With all due respect, you know, as much as it may impact my business, first of all, I'm subject to the same rules. I'm a U.S. citizen living abroad, so I have a mindset that I try to look at it from both sides. And, you know, I'm not worried about my business. Thankfully we have corporations and other businesses, but from an individual perspective, I try to look at it and say, this is not the way it should be. I'm all for the idea of a move to residency-based taxation. It's the right thing to do worldwide.
Mm-hmm.
Do you think? I mean, on that note, one of the
principles should be that an individual should be tax resident in one country at a time.
And the treaties are built like that. You have a residency article in the treaty that is meant to determine where you are resident. The fact that we have a savings clause in treaties, you know, kind of defeats the purpose of determining residency.
The savings clause applies, of course, to U.S. citizens. Do you think that the view of the United States is that U.S. citizens are not people, and therefore not entitled to treaty benefits?
I don't think it's that they look at it that they're not equal. I just think they want to keep their hands on individuals and maintain their right to taxation. I mean, citizenship-based taxation started after the Civil War, when people were moving abroad, and basically created a situation where they were looking at it to penalize these people that abandoned the country. And that penalty has been maintained for centuries. And it's gotten to the point, especially when you're dealing with international business and the mobility of the world today, that it has become even more extreme than it had been previously. Look, if you look in the 19th...
It's worse now, because when it first came in, you were a citizen of one country and one country only. You became a citizen of another country and you lost your first citizenship.
Correct.
So there weren't these dual citizens all over the place. You want to do citizenship-based taxation. Well, there are people with 3, 4, 5 passports. Who are they going to pay tax to?
You think that other countries might be chomping at the bit here and want to jump on the CBT bandwagon? That's a question that's on the list here.
Yeah, I don't think it's workable. And I think everybody else that's tried it has given it up.
Winston Churchill once said, you know, this is why I'm hopeful there will be change. He said, you know, the thing about the Americans is that, you know, you can always count on them to do the right thing once they've tried everything else. So, you know, hopefully, you know, we're at the point. I mean, funny, we're still talking about this as citizenship taxation, and I do this because this is what the webinar is. But I think that's a horrible way to put it. What this is really about is the United States imposing worldwide taxation according to U.S. tax rules on people who are tax residents of other countries. That's what this really is, right?
That's what citizen-based taxation is. That's what it's irrelevant of where you're living. It's just a matter that your, you know, citizen overrides.
Now,
Yeah.
yeah, now that interestingly, or is it citizenship or is it a form of ownership? To look at my list of questions here today, is citizenship-based taxation equivalent? Well, we know it's taxation without representation, but many kinds of taxation is. But what about, is it equivalent to a modern day serfdom? What do you think about that, Larry? Are U.S. citizens abroad serfs?
I try to look at, I don't know if I want to go that far. Serfdom, and I don't know if it's more of an insult to some of the historical aspects that America's dealt with, whether it's slavery or otherwise. I don't know.
Slavery is a defining thing in American history. I mean, this is not new for America.
I know,
what
but
America's largely been about, isn't it?
But that's been about the person. This, while I think there's maybe to a small extent that this is about the person, taxation is about the money. And it's a bit of a different circumstance than I would call serfdom. You don't have to give 100% of your money to the U.S. You are entitled to foreign tax credits. There is.
Well, would that apply to the transition tax? People have been using their corporations as pension plans. They don't give 100% of their money. They lose 100% of their pension one way or the other. There's
Again,
no way to pay it other than liquidate.
There are some ways to plan it. I think my experience has been, again, over 90% of my clients haven't had to pay transition tax. So again, because you're in high, at least for people in Israel, which is a high tax country, and the foreign tax credit carryovers that they have and so on, they haven't really actually been subject, for the most part, to actually paying transition tax. The idea of compliance is one
Larry, let's just unpack that a little bit here for a minute, okay? I mean, you're right. I'm not disagreeing with you, but I think it's important. You put it that way and you make it seem like that there was no transition tax assessment. Why don't we say the way they paid the transition tax was because they were lucky enough to have foreign tax credits reach into their back pocket as a mechanism to pay that tax? Isn't that more
I completely agree. It's dumb luck that we were able to get most of these people out of. I mean, I would say it's professional knowledge as well, but dumb luck.
Not dumb luck. It's not dumb luck at all. It's taking advantage of circumstance.
Yeah.
I mean, you obviously, if you'd use the foreign earned income exclusion, I don't think you would have had those tax credit carryovers, would you?
No, exactly. And again, that's tax planning amongst the professionals. For those professionals that have been using exclusions, for the most part, really their clients are more we're more at risk to actually have to pay the transition tax. Our default position is always to use foreign tax credits.
Up their credits and they don't have them for something else that comes along that's taxable in the U.S. and not in Israel.
Oh, I agree. It's not. There's definitely a risk associated with that. We actually, where it did become dumb luck is that the Israeli tax authorities in 2017 basically provided a one-time. It's not one time because it happens every few years, but a reduced tax rate on dividend distributions. And so a lot of people took this advantage of dividend distributions from their corporations at the reduced tax rate that created an additional foreign tax credit that they otherwise wouldn't have had to be able to offset against the transition tax. So that maybe that's dumb luck.
Okay, but, all right, well,
but in any
why
event,
don't we all agree on this?
Yeah.
Okay, what I find one of the things I find interesting about the transition tax is how differently it affects people in different countries.
No question.
Absolutely. And this seems to be another problem, with this so-called citizenship taxation stuff. As you say, well, how does it work? Well, I don't know. It depends what country you're going to, right?
Yep.
And that seems, to be sort of rather questionable underpinning for this. But anyway, moving back to FATCA and information reporting and stuff like that. Again, most of the theme today is this FATCA stuff. It seems to me, I'm going to say something, and then I'd like each of you to comment on it, sort of agree, disagree, modify. But it seems to me that what FATCA does, the effect of FATCA is to enhance, is to discourage money from leaving the United States and largely encourage money to come into the United States. Okay, so clearly, by going after U.S. citizens and bringing them, gently ushering them into the U.S. tax system, that would encourage money coming into the United States, wouldn't it?
I kind of disagree with the premise a little bit, if I may, John. I'm not sure that FATCA is meant to bring money in.
But does it?
I would say
Whether it's meant to or not.
transition tax, I think, is meant to bring money in, and so is GILTI. FATCA, in my opinion, is making sure, because there is citizenship-based taxation, that the U.S. has their hands in what is occurring outside. I'm not sure that bringing the money into the states creates a different circumstance, because or creates money coming into America, because either way, whether the money were sitting in America or sitting in Israel or France or wherever it is, it's still subject to taxation. So it doesn't change the FATCA, in my opinion, doesn't change the taxation. Would have happened anyway because of citizenship-based taxation. FATCA is not a reason why somebody would actually physically bring money back to America.
I think the one place where I think it would is people who are trying to save for their retirement, because it's very, very hard to save outside of the U.S. in a way that is tax effective, both where you live and in the U.S. And so therefore, if you want to save for your retirement, and you're not going to be picking individual stocks because you don't have enough money to make a diversified portfolio, best diversified portfolio is a mutual fund.
Yeah.
Well, you better buy that mutual fund in the U.S. if you're a U.S. citizen.
But nowadays, most of these brokers in America are not allowed, and maybe it's because of SEC regulations, but don't allow U.S. citizens abroad to invest in mutual funds. So it's not.
So you're stuck between a rock and a hard place.
A hard place. Correct.
Well, so would one of you please say it then? Therefore, U.S. citizens abroad are disabled from effective retirement planning, correct?
Absolutely.
1,000%.
All right. I think that's the message here.
Anymore, right? I got rid of that because I needed to save for my retirement.
I think that's why everybody has to get rid of it. I think any responsible person at this point, I think, has got to get rid of the U.S. citizenship. It's sad, it's very unfortunate, but I think that's basically where it is here.
I think it actually is something that happens more as people get older.
Yes.
It has to become a more viable option for people at this point, because if you're in your 20s and 30s, where you should be starting to plan for your retirement and aren't at this, or maybe aren't, there are other considerations about potentially relocating to the States, wanting to open up a business, working in the States. Giving up citizenship is not so much on the table.
I think it's a bad idea for that age group. I think it's a bad idea.
But as you get to your 50s and 60s and have long-term, where you're expecting to basically live the rest of your life outside the U.S., it definitely needs to be. But then you get back into the issue you brought up earlier, John, is the issue of the exit tax, the expatriation tax that the U.S. gets you any way, shape, or form. And forget a person's value. A $2 million threshold in today's world is nothing.
Absolutely nothing.
Is nothing, especially when you look at retirement plans.
Yeah. Well, or I don't know. You're in what, Tel Aviv?
Yeah, I'm based in Tel Aviv.
Okay. I presume that a house there costs a good chunk of change.
Sure.
Nowadays. All you have to do, and where I live, and I know where Karen lives, all you have to do is own a house and have a pension plan, and you're there. Plus, you feel poor. That's the interesting thing about it.
You may still have a mortgage.
That is the extraordinary thing. All these people who I help, renounce all this kind of stuff. On paper, you look at that page 5 of that 8854, and it makes it seem like they've got something going on. But the reality is that, they have no cash flow at all.
Agreed.
And then the pension.
not indexing that is a real, I don't know.
Well, I mean, there's so many things that are just pure evil. I mean, one of them is the inclusion of pensions at all.
Right.
I think was a huge, but anyway, I mean, we could do I have done the exit tax, another one of these. We could go on and on about that, but I mean, it is what it means, I think, practically for people who are listening is that I think, it's funny, I was working with somebody on the weekend with exactly this kind of language and this sort of deal. So we got a guy, this guy was, he's making decent money in that. And his view of it was that, well, I'm not paying any U.S. tax, so why should I renounce? And I said to him, something, you're below 2 million right now. 10 years from now, you will not be below 2 million. 10 years from now, you're going to be having to really, really, dig in and worry about this retirement pension type of stuff. If you do not renounce before you hit that 2 million, I mean, this is your last chance to get out of this, right? Before you're not going to be able to afford to get out of it.
It really depends because, in Israel, it's interesting. There are 250,000 U.S. citizens living in Israel currently. And the idea, a lot of those are still not aware of their filing obligations because they were born in Israel. Okay, the banks basically started, going back to FATCA for a second, started looking at the higher risk people, those people that have on their ID cards that they were born in America, people that sound like they're American, and you have these second and third generation Americans, okay, that have dual citizenship from birth. And what at least for those individuals, the idea of giving up citizenship, they don't have to worry about the $2 million threshold because they have the dual country exception. But it's still, for those people that moved out of America, like me, I moved to Israel about 10 years ago. And
where
others.
Are you from, by the way? Where are you from?
Originally New York.
Okay.
New York City.
Sure.
And no, it's fine. And, they're the ones that are really that have this concern, if you move abroad with assets, buy a house or things like that, we're the ones that are going to get screwed, pardon the expression.
Yes, yeah, absolutely.
To have to deal.
What's very interesting about it is this. I mean, there are a few things in life that I think are as unfair as those 877A exit tax rules. But, example I often use is, so let's say you've got somebody born in America who moved to Canada at age 10 or some such thing, right? Later became a Canadian citizen. In other words, no dual citizen from birth. Whole life in Canada, everything they want to renounce, they're going to lose it all. Compare that to somebody who was born in America to Canadian parents, makes his fortune in the United States, right? He's born a dual citizen, decides he doesn't want to pay an exit tax, just moves back to Canada, for 10 of the last 50 and avoids the whole thing. Right. I mean, this stuff is so indescribably unjust. It's unbelievable. But anyway, going back here to, as I was telling Mateo, we could probably do a weekly show on this. There's so many issues, but going back to this FATCA thing. Now, there's a lot of discussion about FATCA, CRS, the combination of FATCA and CRS, making the U.S. at the very least evolve into a major tax haven. I think it's well on its way, but what are your views on that?
I think the U.S. has been a tax haven forever. Sorry, Karen, were you going?
Well, yeah, I mean, I definitely the U.S. is a tax haven. As long as they're not going to be following CRS, then for non-resident aliens, this is the place to put your money. Then your home government will never find out about it.
Yeah, I think it's been that way for decades. I mean, if you think before the whole IGAs came into place, there was never any internal U.S. reporting of tax-free income. Look, interest, capital gains, and things like that for a foreigner in the U.S. is tax-free. you
Yep.
could put a million.
So in other words, leaving aside information exchange, the point you're making, which I think is absolutely correct, is that the rules under the Internal Revenue Code very much attract foreign capital to the United States, right?
No question. No
Yeah.
question.
You know,
Although, if I just can add, it also, on the one hand, it attracts investments. On the other hand, I have a couple of clients that unfortunately have passed away while they
oh
maintain
my
assets in
God.
America,
Oh, I'm so glad you raised that.
and they have
Yeah.
a non-adjusted $60,000 estate tax exemption.
Yeah.
That, talk about unfair.
Yeah.
Granted, they're not Americans, and you want to say, okay, you know what, we'll get our hands on whatever we can of the non-Americans. That, putting that aside for the moment, the idea that there's anyone who buys a house to rent out, a non-American that buys a house in America to rent out and then passes away, there's no one that's not going to be subject to
Yeah, you got to structure
You know
this
what it
very.
is?
America wants to bring investment into America. That's where they should be looking to change. Have people come and invest in America without having to be subject to, or at least put a similar threshold or a much more reasonable threshold for avoiding estate tax. You can get so much more capital into America with that than you can with the Americans living abroad, at least in those that are living in higher tax countries.
Yeah, a couple of points on that. First of all, I'd like to break that down. I think that's such an important contribution to the discussion. Okay, you talked about so many things at once, which are such valuable points, but I'd like to break them down a little bit. Okay.
Sure.
So, the U.S. probably has more different kinds of tax than any country in the history of the world. But at a minimum, okay, we have income taxes and we have estate and gift taxes. Now, the income tax rules, as we've just discussed, essentially attract capital from non-resident aliens to the country by taxing that capital very, very favorably or largely not at all. And so that's great as long as you're alive and well. But I think a lot of people don't know about these rules, actually. Okay.
They don't. They don't.
The estate and gift tax. This is unbelievable. Okay. That it's okay to invest in America, put your assets in America, but for God's sake, don't die leaving certain assets in America. Because if you do that, they are basically going to basically confiscate a significant share of those assets. Now, subject to certain tax treaties, yada, yada, yada. I agree with that. But there aren't a lot of countries that have estate and gift tax treaties with the United States. So
Australia does.
Canada does. Israel?
Not, they don't. But
oh my God.
Yeah. No totalization
agreement.
agreement.
Up on this.
No totalization agreement. No estate tax treaty. It's really damaging.
So I think the moral of the story is this: that I think that all physicians, all hospital admission people throughout the world, when somebody is admitted to the hospital and it looks like they may die, I think they need to ask, do you have any assets in the United States? We got to get them out.
It reminds me of the story, actually, John. Back in 2010, where they had the 1 year no estate tax because of the 10-year.
That's right. Yeah.
And you're on December 31st, and somebody's on life support. The question is, do you pull the plug to have them die in 2010 with no estate tax, compared to 2011, where you have estate tax? It was a moral and ethical question that came up under those circumstances.
And now, Larry, now that we've established that you're a CPA with a conscience, which I congratulate you on, we've already established that earlier in this call, what would your advice be?
I'd have to separate my financial background to my religious background. So it's kind of it's one of those. I think I'd plead the fifth.
Okay. One of the issues, there's a lot of criticism of the whole FATCA issue, of course, and one of them is the the IGAs, which essentially obligate countries to turn over everything, including the kitchen sink, but there is no reciprocity in any meaningful sense. I know that France and I think the Netherlands, to a lesser extent, have begun to push back on that. Do you think that FATCA is sustainable? With this one way, you send this information over, we're not going to reciprocate.
I don't know if there's no reciprocation, to be perfectly honest. I mean, we've seen here in Israel, at least, Israel has, from the Israeli tax authorities, have received data dump from America. There were at least 30,000 files sent from America to Israel about Israeli residents. That's just
it's so asymmetrical that it's not funny.
That's true.
What the U.S. sends is individual accounts only, and only if they've got the foreign residence, right? So if you've got your account with your mother's address, in wherever, in New York, whatever, the IRS has no clue that's a foreign account.
Right.
Right. And so that would never be sent. And they don't look through entity account.
Well, that's the actually interesting about the look-through entities. I think some of the things that the IRS has done over the last couple of years is actually geared toward gathering some of that information. And what I mean by that is one example is the disregarded entity filing requirements for owned by foreigners. The idea of having to file an 1120 pro forma with a 5472 for information purposes with the IRS. Putting aside the penalty level for the non-compliance with that is absurd. But the idea of putting that kind of process into play is that was an area where the US could not have any information about who the owners are. And the idea of having accounts or transactions being reported between US disregarded entities such as LLCs and its foreign owner actually moves the dial to give the US more information to be able to report. Does that mean that they will report? No, but I think between that and the greater enforcement on filing 1042Ss and of that nature, maybe the intent is right to try to get more information to be able to report, but practically we don't see a lot of the cross-reporting at the moment.
Don't require them to report the entity
I'm sorry?
stuff. The IGAs don't require them to report most of the beneficial ownership or anything.
I
The
hear
IGAs
what you're saying.
require the individuals, and that's pretty much it.
But it wouldn't surprise me if
that the U.S. would move towards having some of the other information, but there's no requirement that the IRS send anything.
Well, what Larry's saying, I think, if I can paraphrase, and I agree or disagree, I think what you're saying is the longer-term prognosis for reciprocity is towards more reporting from the U.S.
I'd agree with that.
Right. That's.
But I don't think it's ever going to get to the level of what the U.S. is demanding from the rest of the world.
Well,
no.
but the reason for that is the difference between citizenship-based taxation and residence-based taxation. I mean, if citizenship-based taxation were to go, then presumably, the whole IGA thing would have to change because all of a sudden it'd be based on, some tax residency would be based on something to do with residence, rather than citizenship, et cetera.
I think the scope would be limited in that respect. I think, if America were to ever, and hopefully they will, but if they were to ever move to residency-based taxation, I don't think it would basically remove FATCA, because there's still enough homeland Americans, if you want to call them that have assets outside the US that they want to ensure that they have access to. And again, that would still apply within residency-based taxation. So the idea of FATCA going away in total with the removal of citizens-based taxation, I think would be, it would be hard to believe. But on the other hand, it would be significantly less problematic for those non-US based American citizens, obviously.
Right, which is to say, just to jump in here to reinforce, to some extent we're coming full circle here. This really reinforced, I think, Larry, what you're saying is the problem is the citizenship taxation more than the FATCA. Agreed?
1000%.
Right.
Yeah,
So,
definitely.
and I think this is very, very important because I mean, certainly Karen and I think you're, on various social media handles, Larry.
Yes.
I think it's important that all of us work on modifying the language here, right? About where the real problems is, because I think that a lot of people use the word FAC as a catch-all for all the problems. And I think to a certain extent, well, to a large extent, I think that masks, the extent to which it really is the U.S. tax policy of imposing worldwide taxation on people who live in other countries. That's the problem. So I think that, everybody who's in the discussion, I think has a role to play in saying, yeah, I mean, FAC is bad. I agree, but it's not really the root of the problem. The root of the problem, are the tax policies that, although on the one hand, they may have always existed, but there is no doubt that FAC has enhanced knowledge of them and has therefore created a lot of U.S. taxpayers.
I completely agree.
Yeah.
The problem with FATCA really isn't its existence, but the way that it's being imposed on the residents of other countries. The people who aren't resident in the U.S. If they were to remove that part of it.
Which is ultimately the issue of citizenship-based taxation.
Exactly. Yeah.
Yes, exactly. Yeah, I mean, all roads lead to citizenship-based taxation as the problem, and therefore all roads lead to renunciation of U.S. citizenship for people who expect to survive and do financial and retirement planning throughout their lives. I mean, my view of this is that we are looking at, without change on this, we are looking right now at the last generation of U.S. citizens who are going to be living abroad, and they would not be moving abroad if they knew about these rules. That's my guess here. You agree, Larry?
I agree. Actually, it's a major discussion amongst my clients of whether, let's say an American's married to an Israeli, they may not by default, their children may not by default be U.S. citizens. I say to them, listen, 10 years ago, 15 years ago, you wouldn't even be a question. You get your kids U.S. citizenship. Nowadays, we go into all the depth of the discussions and say, is it worth, the $1,000 child tax credit or whatever it is, $1,400 child tax credit to impose or to require your child over their lifetime to spend many, many times over that?
Obviously, the answer is no. Obviously, the answer is
exactly.
Plus, doesn't that give you an increased risk of audit?
The child tax credit? There was a period of time that I don't see it. There was a period of time about 5 years ago where, because of some fraudulent submissions where people were claiming the credit for years prior to the kids having U.S. citizenship, that became a hot button topic, in particular with Israeli claims of credit. But nowadays, it's no different than any other tax filing in my experience.
Okay, yeah, because I think that was about the time period I was reading about the brouhaha over that.
Mm-hmm.
Now, Larry, you say something that's very, very interesting to me. I'm going to ask you a direct question here, and we'll start with a yes or no answer and then explain. Is it your view that somebody born in Israel to one U.S. citizen parent, and that U.S. citizen parent has met the connection requirements of the United States to transmit citizenship, is it your view that person is automatically a U.S. citizen, or the person has a right to U.S. citizenship, but not automatic?
To be perfectly honest, and maybe this is an accountant's answer, it's more of a lawyer question. It's more of a legal question.
Well, I'd like to start with you, though, Larry. You're on the front lines here.
We are, and we basically tell people that they need to speak to an immigration attorney.
Say one wasn't available.
I'm sorry?
What if one wasn't available?
Look,
if they said, I don't want to pay the fees, Larry, I trust you. You tell me, you're a smart guy.
I wouldn't give them a definitive answer, but I think if they meet the residency requirements, they definitely have a right to pass on the citizenship. I'm not sure that by default they are they are deemed U.S. citizens based on my understanding of the law. You know, they won't need to go to the grandparents to get citizenship. You know, if a single parent, but it's only
forget the grandparents. That's a separate statute, separate issue.
Yeah, but my understanding is unless both parents are U.S. citizenship, it's a choice. And then if that's a choice, then that's a discussion that needs to be had with all the implications of that, both from a tax and a compliance perspective, and the difficulties of being a U.S. citizen living abroad, which
Larry, you're talking like an accountant again. Okay, you mean the horrifying consequences of not being able to ever plan for retirement and being subject to worldwide taxation and potential penalties in two countries. Is that what you mean?
It's exactly what I mean. And not only that, the idea that they may not be considered U.S. citizens from birth, that for purposes of expatriation tax, you know, they chose to be U.S. citizens, not by default. So they may not have the expatriation tax exception of living abroad with dual citizenship.
Very interesting point. Karen, what's your view on this issue?
Yeah.
Think about this
just to be pragmatic, I don't think that the IRS is forcing people to acknowledge U.S. citizenship when it hasn't been claimed.
Right.
I think that's probably true. So can we all agree that it would be a very, very bad thing indeed to register your kid as a U.S. citizen?
If you're not going to be living in the U.S., yes. If you have plans to move back, that's a totally different thing.
You can do it later. You can do it later.
Yeah, it's an option.
I'd say it's person specific. You know, if you have significant family in America and you plan to travel there on a regular basis, and while you can, unlike in some European countries where you have freedom to travel on a European passport to America, you would need a visa for a non-U.S. citizen to travel to America from Israel. I think there are a number of different considerations that need to be taken into account, and it's not a one-size-fit-all.
No, it isn't. But hold on a minute, everybody. Let's not run away with this. Look, whose decision ultimately should it be? The kids or the parents?
It should be the kids, but if it impacts the parents while the kids are minors, then I think it's really the parents' decision up front. But that's also part of the reason why when you talk about expatriation, the IRS does give between 18 and 18 and a half the right without implications to be able for a child to renounce.
Okay. All right. One thing I want to add to this very, very quickly, we are getting low on time, but I think this might be important to add. Larry, just yes or no? I should know this, I don't. Israel, visa waiver country or not?
No.
No. All right. Now, this is interesting because there have been some amendments to the State Department rules recently where, you know, they're getting much more aggressive on the issue of issuing visas to enter the United States. But that's another topic. Just give me 1 second here. Two more things that I want to comment on. I'd like to get you to comment on very, very quickly. I think I'll pitch one to each of you, okay? Because we are running out of time. Karen, very quickly, what's up with this married filing separately, a $5 threshold? Are you kidding me?
That is ridiculous, isn't it? And
I'm glad it came from you.
And it only makes, I mean, first of all, it's in the statute. That's why it's there. And I think the reason it's in the statute is because if you've got two U.S. residents that are married filing separate, then they both have to make the same decision with regard to the standard deduction. And so therefore, if you've got one of them, you don't know whether the other's made a standard deduction election or not. So you need to cover your bases and just make sure that everybody files. Whereas when you've got US citizen married to a non-resident alien, they have to file separate, and their spouse isn't filing, so they're not precluded from using the standard deduction. So they might as well have a filing threshold equal to the standard deduction, but the code's just not written that way.
Oh my God, more unintended consequences.
More
Larry,
unintended consequences, exactly.
you know about this Mr. F bar guy?
Mr.
Do
F?
you know Mr. F bar?
I think I've heard of him.
You heard of him, have you? You know, so this guy, at his birth in 1970, okay, the threshold for, reply, I think for compliance on this was 10,000 US dollars. It's
Never
still
moved.
10,000 US dollars.
Yep.
The penalties for, for not complying with Mr. F bar are indexed to inflation. But the $10,000 reporting threshold is not indexed. And Larry, what do you think about this? What's going on?
It's what's going on?
I think Mr. F bar must have huge influence in Congress. Would that be right?
I think well, if I were thinking about it, I wouldn't be surprised if members of Congress actually have accounts abroad. The question is, are they actually filing Mr. F bar? But I think it's ridiculous. I think the idea that goes back to the same question about estate tax for foreigners. There are certain things that just, for whatever reason, are not on the radar, nor are they important to members of Congress. Okay, to have to deal with adjusting them. They don't see the consequences, and in the last couple of years with the increased. There's been a lot more activity to try to get members of Congress to understand some of these issues, but it's slow going. It's like hitting your head on a rock. Sooner or later, the rock is going to break. The question is the head going to break first?
All right. Well, yeah. Okay. Absolutely right. I've got a message from Mateo that we are running out of time, and it's probably a good moment to end exactly the way we did the last one. Things are not good at all for tax compliant Americans abroad out there. And Mateo, all roads lead to renunciation, yes?
I guess that's the conclusion from these two sessions. I'm going to use the same exact line in the transcript when it comes out. That's good. Thank you very much, John, Karen, and Larry, for another great event. I think we covered all the questions, right? But we're going to have an extra session on the tax treaties. Is that right, John?
Yeah, I think we should do that. Yeah, why not?
Excellent. We'll plan that. We have a few lined up for the next couple of months, but we can schedule it for September or something, right after the summer.
There's some issues that are just enduring issues. There will always be tax treaties. There will always be problems. And at least within a few months, there will still be Americans abroad. Maybe not a year from now, but
it's never ending. Hopefully, hopefully it ends at some point. But anyway, so thank you very much. I'll get some admin issues out of the way before I say goodbye. To everyone listening, we have recorded this event. The video recording should be out within the next few days, and we'll have a transcript available within 2 or 3 weeks or so. And we'll make sure to share all of that with everyone, all TaxLinked members, via social media, etc. If you have any follow-up questions for John, Karen, Larry, or Leonard, make sure to submit them in the pertinent forum, and I'm sure they'd be happy to take a look at those. And if you want your CPD credits and you're paying attention, get in touch, and we'll send you that certificate. So without further ado, thank you very much, John, Karen, Larry. I hope you have a good rest of the week, and we'll be in touch for the third session sometime in September.
excellent. Okay.
Excellent. Thank you very much. Enjoy your holidays too, Larry. Thanks for doing this during your break. Bye.
Take care. Bye-bye.
Bye-bye.